Here's a number I want to start with: 8. That is how many consecutive quarters Zions Bancorporation has expanded its net interest margin. 8 quarters in a row. From below 3% in mid-2024 to 3.31% today. And this morning, the bank reported Q1 2026 earnings per share of $1.56 against a consensus estimate of $1.40. That is a 16-cent beat, or roughly 11% above expectations.
And the year-over-year comparison is even more striking. $1.56 versus $1.13 a year ago. 38.1% earnings per share growth in 12 months. And it is happening while the bank is simultaneously improving credit quality, growing deposits, and rebuilding capital ratios that Wall Street said were structurally too thin just 2 years ago.
Zions Bancorporation, ticker Zion, $88 billion in assets, Salt Lake City, Utah. One of the more interesting regional bank re-rating stories in the western United States. I'm Hudson Thomas.
And I'm Lana Chen. Let's dig in.
So let's set the stage. Zions Bancorporation is not quite a household name outside of the Mountain West, but it is a serious bank. Founded in 1873 in Salt Lake City, that is 153 years of operating in the western United States. The company runs its business through 8 regional subsidiary brands: Zions Bank in Utah and Idaho, Amigi Bank in Texas, California Bank and Trust, National Bank of Arizona, Nevada State Bank, Vectra Bank in Colorado, and the Commerce Bank of Washington.
The multi-brand strategy is deliberate. Each subsidiary bank has its own president, its own management team, its own relationships built over decades. The idea is that local bankers with local knowledge make better credit decisions than a centralized underwriting committee operating 2 time zones away. It sounds obvious, but it is surprisingly rare at banks above $10 billion in assets.
The geographic footprint matters too. 11 western and southwestern states. That puts Zions in some of the fastest-growing metro areas in the country: Salt Lake City, Phoenix, Las Vegas, Denver, Seattle, Houston. The western U.S. has added population at roughly double the national average over the past decade. When people and businesses move to your footprint, organic loan growth follows.
And the bank is not a pure lending shop. Wealth management, capital markets, treasury management, and mortgage banking bring in fee income that accounts for roughly 30% of total revenue. That mix provides some structural insulation from the pure net interest income volatility that a lending-only bank would face.
9,392 employees. The CEO is Harris Simmons. And there's one chapter of this bank's recent history that makes the Q1 2026 results even more meaningful.
The NIM compression episode of 2022 through 2024. When the Federal Reserve started raising rates, Zions initially benefited. But the bank held a large portfolio of fixed-rate securities that had been purchased when rates were near zero. As deposit costs repriced faster than those fixed-rate assets rolled off, net interest margin actually declined from above 3% to below 2.8%. That spooked investors who concluded the bank was structurally disadvantaged versus asset-sensitive peers.
And now, 8 consecutive quarters of expansion later, that thesis is looking considerably weaker.
The reversal has been systematic. As fixed-rate assets matured and repriced at higher yields, as loan pricing caught up to the rate environment, and as deposit betas stabilized, the margin has recovered, and then some. This is not a one-quarter pop. This is a durable structural change in the earnings mix.
Harris Simmons has been CEO of Zions since 1999, 27 years running the same institution. His father, Roy Simmons, led the bank before him. This is not a management team chasing quarterly earnings targets. This is a multi-generational banking family with a long-term view.
Institutional investors use words like conservative and consistent to describe Simmons. He is known for disciplined capital management, which is exactly why the 2022 through 2024 rate cycle was particularly frustrating. The balance sheet dynamics were largely outside any single bank's control. What he could control was credit quality, expense discipline, and capital rebuilding. And the results over the past 8 quarters show he managed all 3 well.
The credit quality piece is particularly impressive. Classified loans, those are loans with elevated risk of default, fell 19% year over year in Q1 2026. The net charge-off rate was 3 basis points annualized. This bank is not accumulating problem loans in the corners while the headline NIM improves.
Which makes the margin story even more compelling. You would normally expect a bank pushing for higher yields to be taking on more credit risk to get there. Zions is doing the opposite. Better credit quality while margins expand. That is disciplined lending, not reach for yield behavior.
Let's get into the numbers, Lana.
Starting with valuation, Zion trades at 9.78 times trailing earnings. Forward PE on the fiscal 2026 consensus of $6.28 per share is approximately 10 times. Price to book is 1.27 times. And the metric that matters most for regional banks, price to tangible book value, is 1.49 times, with a tangible book value per share of $42.23.
So, at $63, you are paying roughly $1.50 for each dollar of tangible book value. Where does that fall in the historical range?
It is in the lower half of the historical range for a franchise of this quality. Before the 2022 rate shock, Zion regularly traded above 2 times tangible book. The recovery to 1.49 times reflects partial market revaluation of the franchise, but not full revaluation. The bull thesis is that a sustained NIM above 3% closes the gap back toward 2 times tangible book.
And the quarter itself?
First quarter 2026 EPS of $1.56 versus the consensus estimate of $1.40. That is a beat of 16 cents or 11.4%. Net income came in at $233 million. Year over year, EPS grew 38.1%, from $1.13 in Q1 2025 to $1.56 today.
And that growth happened despite a challenging macro backdrop.
Exactly. Pre-provision net revenue grew 13% year over year. Operating leverage was positive 2.7%. Revenues grew faster than expenses for the quarter. Zions has explicitly targeted positive operating leverage, and the Q1 results confirm they are executing against that goal.
Walk me through the net interest income trajectory.
Net interest income has grown every single quarter for 8 straight periods. $624 million in Q1 2025, $648 in Q2, $672 in Q3, $683 in Q4, and Q1 2026 is running towards $693 million based on the 3.31% net interest margin. That is 28 basis points of NIM expansion in just 12 months.
What about the fee revenue side?
Non-interest income runs approximately $175 million per quarter. Wealth management advisory fees, capital markets activity, customer-related banking fees, and mortgage banking. That brings total net revenue to roughly $868 million in Q1 2026, up approximately 7.4% year over year from the $795 million range a year ago.
Balance sheet and capital.
Total assets are $87.9 billion, cash and equivalents at $661 million, total equity at $7.3 billion, tangible equity after subtracting goodwill and intangibles is $6.2 billion, deposits are estimated at approximately $75 billion, and importantly, deposits grew $2.2 billion year over year. That is organic deposit growth in an environment where many peers were still fighting outflows. CET1 capital ratio is 11.5%, comfortably above regulatory minimums. The tangible common equity ratio grew 19% year over year. Zions has been deliberately rebuilding its capital position for 8 quarters, and the results are visible. Free cash flow on a trailing basis is approximately $950 million, providing meaningful capacity for dividend growth and buybacks. Overall, Zions Bancorporation's financial health is solid. 8 consecutive quarters of NIM expansion, improving credit quality, organic deposit growth, and disciplined capital rebuilding. The caution flags are rate sensitivity and a forward EPS growth rate of 6 to 7% through 2028 that assumes some NIM normalization ahead.
What does the analyst community make of all this?
The consensus is hold. Of 23 analysts covering Zion, 7 carry buy equivalent ratings, 15 are at hold, and 1, Barclays, maintains an underweight. The average price target is $64.24 against the current price of $63.05. That implies roughly 1.9% upside, essentially zero. The market is calling the stock fairly priced.
But there has been some movement at the margin in recent weeks.
Yes, and it matters. Morgan Stanley upgraded Zions to overweight on March 2nd, explicitly citing the NIM inflection as more durable than the consensus was pricing in. Baird followed on March 9th with an upgrade to outperform, citing the deposit stability and margin trajectory. Both firms pointed to the same thesis. This is not a one-quarter NIM improvement, it is a structural shift. On the other side, Barclays has maintained the loan underweight since January. Rate sensitivity and commercial real estate remain their concerns.
Consensus hold with a target barely above the current price. That seems familiar.
It mirrors the Zion historical pattern. The bank tends to beat conservative analyst estimates, but the consensus does not move aggressively until the pattern is undeniable. With 2 fresh upgrades in 6 weeks, that recalibration may be beginning. If Q2 confirms the NIM trajectory, more analysts may follow Morgan Stanley and Baird.
What do the forward estimates look like?
17 analysts have FY 2026 EPS at $6.28, rising to $6.66 in 2027 and $7.09 in 2028. Revenue consensus for 2026 is approximately $3.5 billion. Those estimates bake in some NIM deceleration from current levels, which means if the margin holds at 3.3 or expands further, there is room for meaningful upward revisions.
Let me make the bull case. The NIM story is real and may have more runway than the consensus assumes. Zions entered the rate cycle with a larger-than-average portfolio of fixed-rate securities, which hurt them when rates rose, but those same securities are now repricing at higher yields as they mature. That creates a natural margin tailwind that does not require any new risk-taking. Stack on top of that, classified loans down 19%, deposits up $2.2 billion, tangible common equity ratio up 19% year over year. The bank is simultaneously growing, improving credit quality, and rebuilding capital. And you are paying 1.49 times tangible book for all of it.
Here is the bear case. Rate sensitivity cuts both ways. The NIM expansion was driven by the rate environment, and if the Federal Reserve cuts faster than expected through 2026, that tailwind reverses. Zions runs an asset-sensitive balance sheet. It benefits from stable or rising rates and suffers when rates fall. The bank's commercial real estate portfolio in Western markets, particularly California and Colorado office exposure, remains a watchpoint even as classified loans are trending down. And the 1.49 times tangible book, while historically cheap for this franchise, assumes the NIM recovery story plays out fully. If it stalls, the re-rating thesis stalls with it.
A bull case built on structural asset repricing versus a bear case built on macro rate risk.
Which is exactly why 15 of 23 analysts chose to sit in the neutral middle. The range of outcomes is genuinely wide depending on where rates go.
Let's stack Zions against some peers.
The key regional bank valuation metric is price to tangible book value. Zion is at 1.49 times. Cullen/Frost, CFR, a Texas regional, similar in culture and quality, trades at about 2.1 times tangible book. Western Alliance, WAL, is around 1.7 times. Regions Financial, RF, which covers the Southeast, is closer to 1.4 times.
So Zions is cheaper than Western Alliance and Cullen/Frost, and roughly in line with Regions.
Yes, and the case for closing the gap with CFR and WAL is the NIM trajectory. Cullen/Frost carries a premium partly because it has consistently maintained margins above 3%, which Zions is now demonstrating it can do as well. If the market begins to treat Zion's NIM as structurally durable rather than cyclically assisted, the valuation should converge towards CFR and WAL. That would imply a price 20 to 40% above today.
And how does the NIM itself compare?
Zion is at 3.31%. Cullen/Frost is around 3.15%. Western Alliance is around 3.6% because of its tech-focused deposit mix. Regions Financial is around 3.5%. So Zions is now competitive on margin, which is a meaningful shift from 18 months ago when the market wrote the bank off as a structural margin laggard.
Let's check in on what the options market is saying heading into Q1 results.
The put-call ratio was approximately 0.85, below 1, meaning slightly more call volume than put volume. a modestly bullish lean. Implied volatility was sitting at the 28th percentile, which is quite low for an earnings week. The market was not positioned for a large move in either direction. Largest open interest was concentrated at the $60 put and $65 call strikes for late April expiration.
Low implied volatility is interesting given the EPS growth rate we just discussed. You would expect more uncertainty.
When a bank consistently beats estimates, the options market stops pricing in large downside surprises. The implied move was roughly 3 to 4% in either direction. With a 16-cent beat versus the 140 estimate, there may be some call-side activity in the sessions following the announcement. Low IV also means call options are relatively inexpensive for anyone with strong conviction on the NIM durability thesis.
On the insider side, any notable activity in the past 90 days?
Form 4 filings show 3 modest executive sells through pre-planned 10b5-1 trading plans. These are routine tax withholding transactions, not discretionary exits. No open market purchases were reported. The absence of insider buying at current prices is consistent with the neutral analyst view that the stock is approximately fairly valued, but it is not a red flag given the CEO's personal financial position.
Harris Simmons' 2.2% ownership stake is not trivial.
Correct. 2.2% of a $9.3 billion market cap is approximately $200 million of personal wealth directly tied to Zion's share price. That is the definition of alignment. You do not need executives buying shares on the open market when the CEO already has $200 million riding on the outcome.
Main risks to keep in mind.
Rate sensitivity is the primary one. Zion's runs an asset-sensitive balance sheet, meaning the bank benefits when rates are stable or rising and suffers when rates fall. If the Federal Reserve accelerates rate cuts through mid-2026, the NIM at 3.31% could compress back toward 3%, and the 38% EPS growth rate becomes very difficult to sustain. Some of the multiple expansion opportunity disappears with it.
What about commercial real estate?
Still on the watch list. The Western office market, particularly San Francisco, Los Angeles, and Denver, has not fully worked through the pandemic-era vacancy overhang. Zion's has meaningful commercial real estate exposure in those markets. The classified loan trend is encouraging, down 19% year over year, but CRE is a sector where stress can materialize over multiple quarters, not overnight.
Key metrics to track over the next few quarters.
3 things. First, NIM trajectory. Can Zion's hold above 3.31% in Q2 2026 as deposit repricing continues to normalize? Second, classified loan trend. The 19% year-over-year improvement needs to sustain or improve. Any reversal would raise questions about CRE underwriting. Third, deposit growth. The $2.2 billion year-over-year increase is the structural proof point. If deposits reverse, the NIM durability story becomes harder to defend.
Let's bring it all together. Where does this leave us on Zion's Bancorporation?
This is a well-run Western U.S. regional bank in the middle of a deliberate margin recovery that is now 8 quarters old. The Q1 2026 results were better than expected. Credit quality is genuinely improving, deposits are growing organically, and the capital position is rebuilding. The 1.49 times tangible book looks reasonable if the NIM story continues, and potentially quite cheap if the bank re-rates towards CFR-like multiples as the durability becomes undeniable.
The key metric to watch is whether NIM holds above 3.3% in Q2 and Q3 2026. If it does, the Morgan Stanley and Baird upgrades may not be the last ones. If NIM compresses, the re-rating thesis stalls and the hold consensus looks prescient.
The risk is straightforward. Rate cuts arrive faster than expected, and a bank that benefited from a specific rate environment finds itself running in reverse. The CRE portfolio adds another variable that requires monitoring. Neither risk is a certainty, but both demand attention.
8 consecutive quarters of NIM expansion, a double-digit earnings beat, and a credit quality trend that is running in the right direction. That is not a turnaround story anymore. That is just execution.
That's a very clean way to put it.
We will leave you with this. Benjamin Graham once wrote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." For 2 years, the market voted against Zions because of rate sensitivity concerns and balance sheet positioning. Now that the earnings power is being weighed, 8 quarters of NIM expansion, 38% EPS growth, classified loans falling, the scales are starting to shift.
That is exactly the right frame for this one.
That is going to do it for today's episode of Charged Alpha, your S&P 500 stock encyclopedia. We covered Zions Bancorporation, the Salt Lake City regional bank whose margin recovery story is entering its 9th quarter with no signs of stalling. And hey, if you want to run the same research workflow we use to build these episodes, everything is free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
Until then, I'm Lana Chen.
And I'm Hudson Thomas. We'll see you next time.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall